Corporations engage in restructuring as a strategy through which a firm alters its corporate structure. Failure of an acquisition strategy often precedes a restructuring strategy. Restructuring may occur because of changes in the external or internal environments.
Restructuring refers to significant changes in the composition of a firm's set of businesses and/or financial structure. From the 1970s through the 2000s, strategies like divesting businesses and downsizing dominated the landscape of corporate restructuring. Restructuring is a global phenomenon used by firms across industries and regions to adapt to internal and external changes. During this period, restructuring strategies typically fell into three primary categories: downsizing, reducing costs by laying off employees or eliminating operating units; downscoping, focusing on core businesses by divesting unrelated operations; leveraged buyouts, LBOs, restructuring assets by taking the firm private, often to enhance efficiency and correct managerial issues. Firms often adopt restructuring strategies in response to shifts in their external or internal environments. For example, emerging opportunities in the external market that align with a firm's core competencies can prompt restructuring.
Downsizing is the intentional reduction in the number of employees, operating units, or both. Historically, downsizing was seen as a sign of organizational decline, but today it is recognized as a legitimate and often necessary restructuring strategy. While downsizing may not always change the composition of a firm's business portfolio, it is frequently used to cut costs and improve operational efficiency. Reasons for downsizing: cost control. Firms downsize to reduce expenses associated with labor and operating inefficiencies. Focus on core markets. By reducing scale, firms can concentrate on fewer products and key markets. Example of downsizing: in 2019, General Motors announced the closure of several plants and eliminated approximately 15,000 jobs to streamline operations and focus on electric and autonomous vehicle development. This downsizing effort was aimed at reducing fixed costs and reallocating resources to emerging technologies.
Downscoping involves the divestiture, spin-off, or elimination of businesses that are not aligned with the firm's core strategy. Unlike downsizing, downscoping often has a more positive effect on firm performance because it allows firms to focus on their strengths and mitigate the complexity of managing unrelated businesses. Benefits of downscoping: reduces over-diversification, making the firm easier to manage. Enables top-level managers to better understand and lead the firm's primary businesses. Helps retain key employees essential to the firm's core operations. Example of downscoping: in the early 2000s, PepsiCo divested its restaurant businesses, including Taco Bell, Pizza Hut, and KFC, to focus on its beverage and snack divisions. This strategic move allowed the company to prioritize its core operations and improve overall performance.
A leveraged buyout occurs when the management of a firm or an external party buys out the company's assets, primarily using borrowed funds, and takes the firm private. The new ownership restructures the firm, often by selling off non-essential assets to reduce debt and improve efficiency. Motivations for LBOs: to correct managerial inefficiencies or poor decision-making, to align the firm's operations with shareholder interests, to improve performance and prepare the firm for future sale or public offering. Types of LBOs: management buyouts, MBOs. Executives or managers purchase the firm. Employee buyouts, EBOs. Employees collectively acquire the firm. Whole firm buyouts. External firms or private equity investors take over the company. Example of a leveraged buyout: in 2007, Hilton Hotels was acquired in a leveraged buyout by private equity firm Blackstone for $26 billion. Blackstone restructured Hilton's operations, sold off underperforming assets, and improved profitability. By 2013, the firm successfully relisted Hilton on the stock market, achieving a highly profitable exit.
Strategic drivers of restructuring. Firms leverage restructuring to adapt to changes in their environments or to capitalize on emerging opportunities. These strategies can help companies enhance operational efficiency, focus on core competencies, correct managerial inefficiencies, align resources with long-term strategic goals. Through examples like General Motors' downsizing, PepsiCo's downscoping, and Hilton's leveraged buyout, Restructuring demonstrates its versatility as a tool for firms to remain competitive and sustainable in dynamic markets. The short-term and long-term outcomes vary depending on the choice of restructuring mechanisms. Managers should choose among the restructuring alternatives with a complete understanding of long-term and short-term outcomes.